Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, sitting alongside my co-founder, Mr. Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else. Hey, really quick, we are going to be in New York, November 11th through the 15th. So if you are a prospective investor and you'd like to meet up with us, meet up and have coffee and learn a little bit more about our money management services, reach out to invest@focusedcompounding.com. Again, that's invest@focusedcompounding.com. So today's podcast, we have headphones on, and going forward, that typically only means one thing. In the past, people, didn't know they didn't see us because we weren't recording it. But when we have headphones on, that means that we have somebody on the line with us. And today, we have a Focus Compounding contributor who's written up a lot of posts for the website, Stephen Gamble. He is with us live from the UK, and he writes at gambleinvest.com. And we are going to be talking about Burford Capital Limited. And this is a stock that he actually had written up for the website, or he was in the process of writing up when the whole, I guess you could say, debacle with Muddy Waters came out. So he, I think, stopped writing for the website, and then, we decided that, we're going to post the post on the website, and then we're also going to do a podcast on it. So that is going to be a premium post that we make free for everybody. Right. So definitely check out all of Stephen's work. He's been a great contributor to the website. And Stephen, I want to thank you so much for coming on board with Geoff and myself here today. How's it going from the UK?
It's going great, yeah. Thank you very much for having me on.
Yeah,
I'm excited to appear. So
yeah, absolutely. So, obviously, thank you so much. And now you're a doctor, is that correct? What's your background in?
Yeah, I'm a chemist. I've got a PhD in reversible fuel cells. So I studied the sort of fuel cells for energy storage. So you can store and release electricity when you need it. Right now, I'm working for a large multinational corporation developing respirators. So I'm doing sort of technology development for them.
Interesting. Yeah, that sounds great. So let's kind of get into Burford, and obviously this has been a very controversial stock lately, and mainly because of the Muddy research report that came out. And obviously we both read your report for the website, and it's great. And again, that is available for free for everybody listening. Go to focuscompounding.com. And first, maybe just let's give a background. I mean, why were you even interested in the company in the first place?
Well, I got in touch with Geoff really to learn from him and yourselves about how to analyze companies, because I've been investing in stocks for a number of years, but recently decided to become more serious about it and really go in depth on the analysis. And so I think there was a list of companies that Geoff suggested were interesting, and Burford was one of those. So I looked through the list of companies and I thought they were interesting. They had very good returns on investment, strong share price growth over the last few years. And they were in an interesting industry, litigation finance, which I'd never heard of before. So I thought this would be a good challenge to try and analyze the company.
Yeah, no, that's very interesting. I mean, it seems like a very complicated company. I mean, litigation finance, I've never even heard about it, really until learning about this company and when everything came out with from the report and the short report. So I guess maybe give a background on the industry, litigation finance, and why does it exist? Who does it serve? Maybe you could just give the listeners a little bit of an introduction on that.
Sure. Well, you can think of it very simply as kind of a corporate no-win, no-fee industry. So in the personal claims space, there are many companies offering this service, but for corporations who maybe they have somebody has infringed some of their patents, or they want to defend themselves against accusations from another third party. But in order to do that, they have to employ expensive lawyers, which is obviously a cost to them. And the real problem for them is that there's a large cost, an unknown time frame, and there's a possibility they could get zero return on it. So it's difficult to justify that to their shareholders, and yet they want to have a chance to win these cases. So there's a number of litigation funders, litigation finance companies now. Burford has been floated about 10 years ago on the alternative investment market in London. I guess the first and the biggest company was IMF Bentham, where they originally founded to do insolvency work, but they've kind of diversified into litigation finance. And they're an Australian company, and they were on the scene for about 20 years or so. And then there's a number of private organizations as well. And Burford is probably now the biggest, single biggest litigation finance company. And they started out doing just core litigation financing cases, but they've diversified into a number of other business lines subsequently.
And
But
how
that
did
remains-
Burford get to be so much bigger than all the competitors? I mean, if you look at the market cap, the debt it's raised and all that, it's far, far bigger, right?
Yeah, that's right. Well, most of the litigation finance companies are quite are much smaller than Burford. Yes, that's right, and a good number of them are private. So I guess they raised about £180 million in 2009, 2010, and I think they had a good, a good track record of doing, picking good investments in litigation finance, and so they were able to raise money. They've had a number of bond issues since then. I think they raised about 600 to 700 million pounds in bonds on the London markets. So they're able to expand their capital base that way. And they also had a recent investment from a sovereign wealth fund, a $1 billion commitment from them. Burford put up about a third of that capital. The sovereign wealth fund put up 2/3. So by expanding their capital base in that way, they were able to then take on a lot more litigation finance claims and grow their asset base rapidly.
Got it. So your title of your post is Burford Capital is complicated to value and so vulnerable to opportunistic short sellers, but this weakness offers opportunities to long-term investors. So I'm kind of curious to hear your, thesis on why you think, this downturn, in the stock or just everything that's been going on with it is really an opportunity for long-term investors. I mean, what's their business model, and why do you feel, like it's a durable business where for long-term investors, it could be a good investment?
Well, their business model is primarily financing legal cases. So they contribute capital for a legal case, and they take all the risk of loss of that capital. But then they would take a slice of the settlement or the judgment at the end of the legal case. So if you, on their website, there is a document released in 2018, which summarizes all their legal cases that have been entered into so far. And I've got a nice graph in my start of my report, which basically shows that about half the legal cases they break even or lose money on, and the other half are profitable, but most of them are a very small profit. And so there's a few cases which provide a lot of profits. So they invest a small amount of money and get a big return. So I guess it's a little bit like venture capital in that way. But by having a large enough pool of cases, they can average out their returns. So the typical case duration is about 1.7 to 2 years from investment to realization. That's the average time it takes to do that. Does that answer your question?
Yeah, no, definitely. And then I'm really curious about, I guess like the Muddy Waters research report. I mean, what is it? So you don't find anything, I guess, troublesome with their like accounting policies and everything that Muddy Waters was referencing. I think they had 7 critical things in their report that they were talking about. I guess that the company is just kind of like sketchy in a way. Does that bother you at all, or do you just kind of not think what they're talking about is material, or kind of what are your thoughts on that?
Well, I think there's 2 main criticisms of Burford in their reports. You could divide it into 2 main things. One is their governance structure. Um, and they would criticize them for being listed on AIM with a lighter regulation than on the main market. And also that they have a number of directors on their board. They criticized the company because the CFO was the wife of the CEO. Burford have listened to investors' concerns about that and have since replaced that with a guy called Jim Kilman, who's a former investment banker from Morgan Stanley. Muddy Waters implied that basically that she was the only person who would sign off the accounts. I don't believe that, to be honest, at all. The other main accusation was about fair value, how Burford values its investments. So understanding how they value their investments is very important to understand the company. So they have a 3-tier structure for valuing investments. Level 1 is stuff that's quoted in the market, easy to value, like equities, for example. Level 2 is stuff which maybe is infrequently quoted or unquoted, but sometimes is a market value. And level 3 is things like legal cases where you don't really know how much it's worth until you have a material development in the case. So 84% of their assets in 2018 were level 3 assets. So Muddy Waters attacked them and said, well, we think they're overinflating their fair value. So they're writing up, basically, they're saying our legal case is worth $100 million, whereas in fact it's only worth 80 at the end, or less. That's just an example. So why I don't think that's fair is because I did an analysis on all the cases that they took from 2009 to 2016. I analysed the cash return over that period, and I found that there was about a 14% return on sort of cash return on their investments in that period. And also, Burford issued a report with 20 concluded investments that they'd settled, come to the end of their court cases, and they showed basically that they'd marked up 2 years prior to the end of the cases. They had marked up the fair value by about 12% of the final settlement value. So, for example, if the case settled for $100 million at the end, or Burford got $100 million at the end, 2 years before they'd ascribed a $12 million fair value increase. 1 year before, they described a $33 million fair value increase. And in the actual year the case settled, they booked the remaining $67 million cash. So, and they also expense all the ongoing expenses of the case. So if you're doing a case this year, they'll book the expenses with that case to their profit and loss statement in that same year. So I don't agree that their fair value accounting is aggressive. And therefore, I would have more confidence in them than Muddy Waters would have. They're well named.
Okay, but do you feel that the Muddy Waters points about corporate governance were more of an accurate issue than the fair value accounting?
I think they probably could improve their corporate governance. Getting a new CFO, I think was a good move. The other point that Muddy Waters made about that was that the directors weren't independent because they'd been with them since the start. So they also promised that their chairman would just step down and be replaced by a new independent director, which I think, again, is a good move. And they've indicated, or they're not promised, that they're going to pursue a secondary listing on the US market. So if they do that, then they'll have to obviously file disclosures with the SEC and so on. So that would be a very good point, at which they demonstrate their bona fides to investing community. But I think they could improve their board, and they've also agreed that the CEO is going to come onto the board as well.
Right. That was unusual that they didn't have a executive on the board. They had 4 directors who had been there for the 10 years or so.
Yeah, that's right.
Yeah. Now, do we want to talk about where they're incorporated? Because that's a little complicated for people, especially for people not from the UK, to understand the situation there and why they don't pay taxes. Can you talk a little bit about that?
Yeah, so unlike their competitors, they have effectively pretty much a 0% tax rate, effective tax rate. Their competitors being IMF Bentham and other company as well. His name escapes me right now. So the reason for that is because they're incorporated in Guernsey. Now, Guernsey is an island which is kind of between England and France. It's one of the Channel Islands, the other one being Jersey. And they have a favorable corporation tax regime because they want to attract companies to incorporate there and bring their business there. And so they're listed, I think they're incorporated as an investment trust rather than an investment company, and therefore they can avoid paying corporate taxes, basically. So they've got a very low tax rate.
Got it. So I'm kind of curious to hear about, I guess, competition in relation to Burford. And I'm just kind of curious, why don't a bunch of, I guess, litigation lawyers, leverage their experience to pretty much set up something similar to Burford? And I guess, why won't a bunch of lawyers, do that? I mean, how do you think about their competitive advantages, and if they have any, and how they could fight off competition that probably will come because their returns are so high?
Mm-hmm. Well, what Burford would say, I guess, on that, are that all their competitors have been around for longer than they have. I mean, there hasn't been any new competitors come into the market in the last 6-7 years, and so they would say, well, if it was so easy to compete, then why haven't we seen competition? So that's what they would say. I've thought a bit about that too. So there's part of it is, I guess, capital and financial risk. So if you have this distribution of cases, 50% of them lose money, most of the rest of them don't make much, and then there's a few which make a huge amount. It does require a certain sort of critical mass of capital to be able to weather that. And it's difficult to sell that to investors because the earnings you get from it are very lumpy. And I think that makes it hard for people to think about investing in it. They would also say that, so they say the advantage of scale. They've also done surveys of lawyers around the world, and they've got good mind share, they would say, of lawyers. And they also would say that they are innovators in the sector. So they are growing faster than their competitors. That can be, demonstrated. And they would say that they were the first people to do things like portfolio financing, where instead of just financing one case with a large corporate client, they would maybe take on a portfolio of cases. And also they are doing other kinds of business like asset recovery and complex strategies. That's where they would take an equity stake in the client that they're serving, so they can pursue the litigation directly, they control the process, and that allows them to choose when they want to settle. And so they would say they're kind of leading innovation in the sector, and therefore they're kind of trying to create the market in some ways. So they also would say that there's a large potential total addressable market, I guess. So they talk about the annual legal fee revenue, I think in the US or globally perhaps being $580 billion to $800 billion. Largest 200 US law firms having annual revenues of $100 billion. So they say that they don't perceive a lot of competition in what they're doing. And they also said that they've just recently started to have a dedicated sales force. Before that, it was more contacting people through the network of contacts the lawyers had. So they haven't seemed to find it necessary to try to aggressively market themselves up to this point because they haven't had a lot of, they've been able to get good opportunities without doing that, just by a network of people that they know.
Got it. So I found two things actually quite interesting when I was reading your report. And I guess the first thing was that the CFO was the wife of the CEO, which you hit on that. Mm-hmm. And now they're bringing a new CFO. I agree with you that that's probably a smart move. And the second thing I thought was pretty interesting was their lack of employee turnover.
Yes.
Can you really talk about that? I mean, if I'm my memory serves right, did they say only 4 employees have left the company and one of them retired and one of them passed away? I mean, what's going on there?
Yeah, that's true. So they have 90 employees, or they had in 2018. I think I might have a few more employees now. And I wasn't able to find many reviews online on Glassdoor or anything, as I think you guys have done before, about working there. What I was able to find was that the average compensation for their employees was about twice as high as for one of their main competitors, IMF Bentham. But I also find that their assets under management per employee was about 3 times IMF Bentham, so they seem to be more efficient. So I don't know exactly why that is, but again, they did a capital markets sort of PR webcast in 2018. So if you want to look in the faces of the people that are running the company and kind of read their body language, then I recommend to do that. And they bring various people from the business and give profiles of the different people from different parts of the business there. So that might be interesting for people who want to delve into that a bit. But they do seem to have good employee retention. And they have some people running the company who have been involved with some big companies before. So I guess it's, I don't know, it's an interesting place to work. And they have a good amount of business in the US and the UK and smaller amounts in Asia.
Got it. Great. So where does most of the revenue come from, like geographically?
I believe it's the US markets mostly where the revenue comes from. I can't remember the exact figures right now. I believe it's mostly in the US.
Got it. And then I guess what have they been doing for capital allocation, and what are your thoughts on that with the CEO?
Oh yeah, I just remembered a bit more about the revenue. So revenue is a bit tricky because a lot of their cases involve international clients. Maybe one company in one country suing somebody else somewhere else. They report the results in US dollars though. They would say about half it's North America, about quarters Europe, and the rest kind of global for the revenue. And then you asked about capital allocation.
Mm-hmm. Yeah, because you wrote in your report that Burford finances its strong growth by reinvesting 92% of earnings, raising debt, and occasionally equity raises. Yeah. So I'm kind of curious to hear about all 3 of those things.
Okay. So they initially floated on AIM and raised £180 million, as I said. They've raised about 600, 700 million pounds of debt since then, and a small amount of additional equity. So the cash that they make every year they pay out a small amount in a dividend, about 8%, and the rest they plow back into the business. I guess they feel that they can achieve a good rate of return on that, and therefore they decide to reinvest it.
Right, and this is something we should talk about because it's unusual for a financial company to do this. They have very high returns on capital. They grew very quickly without using debt, but they also chose to take on debt. So do you think that was for scale reasons so that they could do bigger deals? Why do you think that they chose to do that instead of just only using retained earnings?
I'm not entirely sure. I guess they felt that they maybe wanted to, it's probably pursuit of growth, I guess. Mm-hmm. Their debt was priced about 6 to 7%, and they've laddered their bonds. So the first of them start maturing in 2022, I believe, and then you have about 1 year there from that. They have about a series of about 4 or 5 years where their bonds mature.
Okay. Because I'm just saying, because before the Muddy Waters report came out, just to give people an idea here of how hot a stock this was, how well performing it was, the stock was probably up 12 times its initial price, share price?
Yeah, the initial share price was £1 or 100 pence as it would be priced in the end.
Right, and
just before the report came out, it was about 1,250 pence or so.
Right.
Yeah.
Okay. So
over 10 years.
Clearly, if they had not used debt, they still would have had an amazing stock performance.
I would presume so. Yeah.
And in the same period, the market had a very low return. So were you surprised by? I read the Money Waters report. You read it. Were you surprised by how much the stock dropped, considering that there's not a lot in that report that would be news, I think, to people, looking at the stock. I mean, it deals with the complexity of the accounting, but people looking at the stock would have known that the accounting is pretty complex.
Yeah, I guess I was surprised because, personally speaking, I thought it was a good investment opportunity before it dropped. So, yeah, I was pretty surprised at that. Burford alleged that there was some market manipulation of the stock price. I don't know about that. I think it's almost irrelevant, really, because even if that's true, if investors were confident, then we've been bid back up again afterwards. So,
right. Yeah.
I think it's more of a non-issue, really, to be honest.
So, do you think the shareholder base was not a very strong shareholder base that was willing to sell out that quickly? They didn't have the kind of conviction that you do in the stock?
Yeah, I think so. I think, I spent a good bit of time analyzing this company, and to be honest, Warren Buffett, he would say, if you need a spreadsheet or to analyze a company, then maybe you shouldn't do it. Mm-hmm. This is a company you kind of need a spreadsheet for, I feel. Really to understand fair value and just to check that the returns are as they appear to be. I think it takes a lot of looking into, and I think a lot of investors might not have done that. So, and they were keeping a good few people investing for the momentum. Mm-hmm. So whenever there was a big shock to the share price, they would have sold out. That was my guess, anyway.
Sure, and their CEO, I think the research report, it talked about the CEO selling stock. Did you have any thoughts on that?
Yeah, he sold. So the CEO and the chief, what they call a chief investment officer, Jonathan Mallow. Jonathan Mallow is a law professor from Georgetown, I believe. They had about a 8% share each in the company since it was founded. And then a couple of years ago, they sold about half their stakes each. Since this plunge, so they got about, I think they got $110 million or so when they sold half their stakes each. And since this plunge, they've reinvested about, between them about $10 to $12 million altogether. So they haven't put all their money back in that they took out, but I guess, I don't think it's for me, it's not a big issue that they sold off some of their stake, because the share price was very high at that time, I feel, and so I don't have a big issue about that, really. They have shown some support by buying recently, and they are still significant shareholders in the company. So I feel that they're there for the long term, and they're not trying to just pull the wool over people's eyes. I think they definitely believe in the long-term future of the business.
Got it. And then I guess to talk about the growth section of your write-up, you had said Burford is growing net assets at 26% compounded over 5 years and EBITDA at 42% CAGR over 5 years with a very long ramp for growth available. So I'm kind of curious to think about or hear you talk about, what available growth and then how you think about their growth going forward and why that's sustainable.
Well, I guess my thesis would be that there's a large sort of addressable market, as I mentioned before, and that even if they were to take a little part of this, they would still have substantial growth potential because they're still quite small relative to the size of the market. And I think there's also a trend towards litigation finance. Singapore recently legalized it because I guess what you need to know about litigation finance is that it's illegal in some places. So Ireland, for example, it's illegal. And really that comes from medieval laws in the UK and Ireland where people were forbidden to finance other people's legal claims to stop other people harassing other people unjustly when you had a kind of feudal system. And from what I've seen of their, as I mentioned, their competitive position, they don't seem to be struggling to invest their funds. So I think they've got a good option for longer term growth.
And then maybe we could just talk about, because the price has dropped so much, I mean, how much do they really have to grow compared to what they grew in the past to justify the share price today?
Yeah, so the share price today, I think it's in single-digit PE. Of course, so if you look at their earnings, they are composed of cash earnings and also what the fair value increases. So, I mean, if they currently are valued about 7 times, I think, 5 to 7 times. So they wouldn't really have to grow their capital base very much at all if they just reinvest what they've got right now. They would easily be able to maintain their current value and grow it. I haven't got precise figures as to how much they would grow right now over that.
How do you think about valuing the company?
Okay, so I put 3 different ways to value the company in my report of varying levels of conservatism. The first one was looking at the cash return on the capital employed. So I looked at their cases from 2009 to 2016. I figured out how much they had produced in cash earnings, and then how much they had in terms of ongoing cases at the end of that period. And if they got the same return in the ongoing cases as they did as the ones that already concluded, I calculated to get about a 14% annual return on their money. And then I basically took the assets that they had in 2018 and worked out what that would be, assuming that they maintained their current asset base and they didn't repay any debt. So I came up with a figure of about 10% returns in just that steady state. And that's just the cash returns, basically they've demonstrated in the past. So the shares at that would be the net assets per share would be about $5.50. Shares are priced at 1.5 times net assets, so you could get based on that about an 8% cash return without any leverage. And that assumes you don't have any re-rating of the stock's price, which is currently about 5 times earnings at the time of that analysis. And then you can look at including the fair value as well to get a higher appraisal. And then you can look at a re-rating of the business as well. So I guess the long-term average of the price to earnings ratio is about 15. So they're rated at about 5 at the time I wrote the report. So if you were to re-rate the business and grow, you would get a very high compound annual return.
Got it. Yeah. And I guess, so I was so fascinated that, because I guess from your perspective is you had not invested in the company prior to the Muddy Waters research report. So I'm kind of curious, when you woke up and you saw the stock down, what was it, like 30, 40, 50% in a day? What was your process like of, gaining the conviction to invest in the company? Do you just think a lot of what they said was not material? Do you think it was baseless? What do you think that it'll be like for the company going forward? Like, do you think it's really just a distraction for the company, but they're going to be okay? I really just want to know, how'd you gain that conviction to actually invest in the company after, they came out, the shares just dropped like crazy, and now there's sort of all of this, I don't know what you want to call it, just distraction around the business. Did you really just view it as really a pretty, great opportunity? Because a 50 or whatever it was, 40 to 50% drop obviously is pretty material. So I'm kind of curious how you got past, or what your process was like to get past, their claims and the report in general to actually invest in the company.
Well, actually, I did invest in the company before the drop.
Okay.
And then I bought more shares afterwards.
Okay.
So I did have the confidence to invest in them when they were about sort of 1,250 pence. But then I bought more shares after they dropped. So I reduced my cost basis there. And I guess I thought, well, what if the company couldn't raise any debt because the capital markets were closed to it, for example, because investors maybe lost confidence in it? Mm-hmm. What if the company had to survive just based on what it's got right now and it didn't raise any more equity? Would it still survive? And I thought, yes, it would, because, for example, in 2018, their cash flow was about $530 million. So based on that, if they chose to, they could repay all their long-term debt by shrinking the size of their balance sheet quite easily in like 1 or 2 years. So even if the debt came due, I thought the financial safety of the company was good, and I thought their returns were good, and I thought that they wouldn't necessarily be negatively affected by the negative publicity, and so therefore I guess from my point of view, I would be okay with. I don't think they rely on any external influences like raising extra money to survive, and therefore that's one of the key things for me. I guess one of the key risks is the unpredictability of their earnings. Mm-hmm. So because of if you've got that graph where you have a very few cases, like Muddy Waters was right when they said that 4 cases made up like 50% of their earnings.
Right.
That's true. But I mean, if you invest in a lot of cases, and then what they did actually was they chose to exclude those 4 cases from their analysis, right, of Burford's position, which is, I feel, unfair. If they'd done that, they should have excluded the 4 worst ones as well, that lost the most money. So therefore, the risk I would perceive is that Burford currently has, for example, a case it's called Peterson, which is about nationalization of an Argentinian oil company, I believe. And that's worth a lot of money to them. So it's really these big cases, whether they come off or not. And so therefore, just by the laws of chance, there'll be some years where they have fewer of those. Some years they have more. From my analysis of it, I think that on average they'll do well over time, but that is a risk I would perceive. But I was okay with taking that risk, I guess, based on my analysis of average returns. So that answers your question.
Okay, so you would look at it kind of like venture capital, right? I mean, we're talking about,
Yeah.
to give some ideas, there's the graph here that people can see when they look at the article. But in addition to the 4 being a large part of the returns, probably, I don't know, 10% or something, some number not that much above 10% or so of the cases would make up like the vast majority of their profits. They
Yeah.
As you said, I think you have that they, okay, 58% of cases give a positive return, but a lot of those positive returns are not big.
That's right.
Right. So it really is like venture capital in that maybe 1 out of 10 are huge home runs that are driving most of the earnings that you're going to end up getting.
Mm-hmm.
Right.
Yeah.
But that's likely to be true in the future too.
Yes.
Do you think that actually them having success early on with some cases may have been part of what helped attract capital to them? I mean, with venture capital firms, some of the ones that were lucky early on or were successful early on, then get to see some of the best deals, have some of the most capital.
Possibly, yes. I guess I'd need to look at the timing of when those successful cases, resolved. Um, I think they had an early case that was successful, but it wasn't. It was a number of years before they knew it was successful. So
Okay.
I think it was one of their 2009, 2010 vintage. It gave a very good return, but I think it was 2 or 3 years, maybe 3 or 4 years before they knew it was successful.
I guess what I'm getting at is if you thought that Burford was likely to only have the kinds of returns that a competitor like IMF Bentham or something had, would you still have faith in the company, or do you think it's something particular to this organization that you're betting on?
That's a really good question. Yeah,
I mean, because
I
it's a
guess
little difficult to see, but from what I can see of competitors, right, they really have not had as good results as Burford at all.
that is true.
Okay.
IMF Bentham made a loss last year, and they sold off part of their portfolio into a fund in order to be able to pay one of their bond issues when it came due. So, and they admitted that they sold it below the net what they thought the value was in order to access cash for that. I guess maybe what's behind your question is what's special about Burford that means that this will continue into the future.
Right. Yeah.
Yeah. So I guess my best guess to that would be they've got a good scale and they are definitely the kind of the market leader in their field, and I think that they will probably therefore tend to be able to attract the best cases. They also, because of their size, they are more likely to have averaged out returns because they're investing in so many cases. The bigger they get, I guess, the more averaged out their returns will be as they scale up. Why they're more successful than their competitors? That's a really good question. And as I mentioned, I talked about some of the things earlier, like they seem to have a good network of people, and they're very well known. And they also seem to work with their clients to try and do things, I guess, beyond traditional litigation finance. And And they also attracted something that none of their competitors did, which was this investment from the sovereign wealth fund, which is very attractive for them because they put up a third of the capital but get about 60% of the returns. So I guess their clients, their customers perceive something about them that other companies necessarily don't have. And I think it's to do with their scale and visibility and mind share, I guess. But that is a good question.
And what risks, I guess, do you see with the overall investment? I mean, you outlaid, I guess, to kind of come in closing here. I'm kind of curious to hear. I mean, you had said that the main risk in the valuation of assets of Burford Capital is 85% of the assets on the balance sheet. 1.43 billion of the 1.67 billion are described as level 3 assets. Does that worry you at all? Because that was sort of the main concern of the Muddy Waters research report, that majority of the assets are that level 3 assets?
That kind of comes with the territory of litigation finance. Those 84% of assets are they're court cases essentially, where what Burford does is it doesn't adjust the value. It carries about 2/3 of the cases on its books at cost through to conclusion. 1/3 of them it adjusts for fair value, and that's subject to a process which is described in their annual report, but it's not fully transparent in that they're taking inputs from lawyers and in terms of how the case is going, but they don't want to fully reveal that information because they think it might prejudice the cases. So investors don't get a real fully good insight into all that. Yeah. So can you repeat the question again? I want to make sure I answer it properly.
Well, are you concerned that they're level 3, so that they have to mark these themselves? That we're not getting, this isn't mark to market. Basically, this has to be done by the company.
Mm-hmm. I guess it is more concerning than other types of assets. From what they've published of their historical track record, they seem to not be aggressive in their fair value accounting. And I guess what I would say is the same people who produced that track record, Jonathan Mallow, the chief investment officer, he still personally looks at valuing all cases with a committee of people. If the people were to change, then I would, or they were to, it would become apparent that there was some change in their markups. Then at that point, I would have to question and think carefully about the value and maybe discount that if I thought they were being more aggressive. It is concerning in that it's a lot less transparent than for another company. But to the best of my knowledge, their accounting isn't aggressive from what I've seen of it and analysed of it.
And that's the industry. They have to do that. That's their business model.
There is a certain amount of that. Now, other companies like IMF Bentham take a slightly different approach. What they do is they don't do fair value changes. What they do instead is they would, firstly, any expenses that are incurred during the case, unlike Burford, who charged them to the income and expense, they charged them to the profit and loss statement. IMF Bentham would capitalise them and add them to the value of the original investment. But then they only take a profit or loss whenever the investment's finally concluded. So all their profits and losses are in cash rather than in fair value increases. So there are different ways to do it. Burford would argue that under IFRS 9, that's the only way they can do it. I think there's a bit of negotiation in that, really, but I guess I would go back to that they have, historically speaking, based on their fair value analysis, they haven't been aggressive. You can go on their website and see their report on 20 cases that concluded and how they deal with fair value. And that explains it fairly well, I think.
Yeah.
And that was something that kind of reassured me and allowed me to finish the report, because I kind of had a bit of a, should I finish this? Should I stand behind this? But I guess hearing more about the fair value and understanding that better gave me more confidence to be able to do that. Obviously, it was a bit of an emotional roller coaster having invested and seeing it plunge, and then saying, you obviously ask yourself, was I wrong? To the best of my belief, I don't think I was, but time will tell. So see what happens.
Awesome. Well, that's great. Well, Stephen, I want to thank you so much for coming on the Focus Compounding podcast. Obviously, you've been a contributor to the website, and everybody can get this write-up that we are referencing for free at focuscompounding.com. We are going to make that free. Stephen,
in the Twitter.
What's that?
That'll be on your Twitter.
And it will also be on my Twitter at Focus Compound. Stephen, if people want to talk to you about Burford and just learn a little bit more about you in general, where can they get into contact with you?
Yeah, so I've got, I've just kind of launched an investing website, which is basically my blog, gambleinvest.com. There's a contact form on there. If you fill that in, it'll send me a message and I'll get in touch with you. I'd be happy to discuss this with anybody, and happy to take questions on my report or what I've done. I just want to say as well, I really appreciate you guys having me in the podcast, and I've enjoyed myself, so thanks very much.
Thanks for coming on.
Thanks so much, Stephen. I want to thank everybody so
Cheers.
much for tuning in with the three of us here today. Geoff and I, we are going to be in New York November 11th through the 15th. If you want to meet up with us to talk about stocks or a new fund or money management services, reach out to invest@focusedcompounding.com. If you're watching this on YouTube, hit that subscribe button, thumbs this video up, and if you're on the podcast side, be sure to hit that rating and review. That helps and goes a long way for us. I want to thank everybody so much for tuning in with us here today. We'll see you in the next podcast. Take care.